Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into another episode of the Money Insights Podcast, where we talk all things money and business. My name's Christian Allen, and I'm here with my co-host. You know him as Rodney, the Pod Zabriskie. Rod, how are you, my friend?
Hey, I'm doing great. And I have a little announcement.
You've been full of announcements lately. I'm excited.
Yeah. So our son, our fourth child, Spencer, is actually enlisted and going into the Army. Starting basic training next week.
Basic training next week?
Yeah.
That scares me a little bit, Rod. If it was me, but I'm feeling very proud of him.
Yeah, I would be lying if I said there wasn't any kind of trepidation or whatever. But yeah, we're excited for him. He's talked forever about going military. What's funny is for a long time he was talking about Navy, and then a few months ago, just to us out of the blue, I'm sure he's been thinking about it for a while. But then he finally decided he's going to go Army.
So. All right, so you're going to have a Green Beret instead of a Navy SEAL.
There you go. Yep. He's going to start. He'll be a tank mechanic to begin with, and
then he'll work his way to Navy SEAL.
Special services.
I'm just kidding. Okay, Rod. Today we're going to talk about tax deferral. People love to talk about tax deferral.
Yeah.
But here's the interesting thing. I say that, and they actually do. Like, people love tax deferral. It's like the loudest voice that suggests tax defer all of your money. I mean, that's at least what it seems like we get from the media. And most financial advisors, to be totally honest, really move people towards tax deferral. Okay, right. Here's the deal, though. Tax deferral comes in various shapes and sizes. Rod, why don't you start by defining what it is?
Yeah, so tax deferral is just the idea that we're, instead of paying tax today when we've earned the income, we're pushing it to some point down the line.
Okay, so you didn't say tax savings, and that's important, right? That's important. What we're doing is we are literally pushing the tax to a future point inside the tax deferral world.
Yep.
Okay, but here's the hard part, Rod. Some things are tax deferred, but also can be brought out tax free.
Yes.
So we also need to kind of define what that looks like. Okay. So what we're going to do is we kind of lumped these into a couple of different sections. Let's talk about the first section. And these are the just like traditional pre-tax vehicles. And specifically, they're the vehicles that you get a tax deduction on the front end, and then the money grows tax deferred. And when you take it out, you have to pay the tax. Okay. Why don't you talk us through what those vehicles are?
Yeah, so these are the kind of retirement plans that we often talk about. So we're going to lump together 401k, 403b, 457.
Okay, those are all just, they're basically like business IRAs, right?
Yeah.
And so if you're, a lot of times people are like, well, what's the difference between 401k and an IRA? The only difference is an IRA is an individual, a 401k, if you're not doing a solo 401k, a 401k is done for a business.
Yes. Yeah. So the IRA is our next thing. Defined benefit plan. You're kind of creating your own pension. And then also for business owners, you have your simple IRA, SEP IRA, different ways that you can be setting aside more money as a business owner than you could as an employee.
Okay. So that basically covers the retirement list. Okay. Now we have another list here that we're talking about. We're calling our post-tax. But before we do that, Rod, I'm going to point out kind of a oddball vehicle that
the Superstar.
It's something, but let's just, okay. So an HSA, this is a popular vehicle these days. And let me talk about why. And can I just say, I like the HSA a lot better than I like just your traditional tax deferral.
Yeah.
If it's used for the right situation. Okay. So an HSA is unique in that you get the tax deduction on the front end. It now grows tax deferred. And then when you pull the money out, it is tax free. It's really the only vehicle that does that. However, there is a catch to it. And the catch is that in order to receive that money back out tax free, it has to go toward qualified healthcare expenses.
Yep.
So you get some tax benefits. And I really do like it. If you're using it for healthcare expense, it's just a really great way to kind of ancillary piece. You get tax savings with money that you were likely going to be putting out anyway.
Yeah.
Okay, Rob, talk a little bit about our post-tax vehicles.
Okay, so post-tax, the first one we're going to talk about is the 529 and Coverdale savings account. So these are obviously for education purposes. So the difference between this and the HSA is you don't get that tax deduction on the front end.
These are just like a lame duck version of the HSA.
Yeah. So you put it in the account, it grows tax deferred. And then when you use it for qualified education expenses, you don't pay the tax at that point on the growth.
Okay. That's important. No tax deduction on the front end.
Yep.
Okay.
And then the Roth obviously is a big one. After tax going in, grows tax deferred. And when you use it, in this case, for whatever you want, but presumably, retirement type stuff, then comes out tax free. And then after that, we're going to include life insurance and annuities. And the reason we do this is because the money goes in after tax, same thing, grows tax deferred. In the case of the life insurance, when you take it out correctly, it can come out income tax free, basically like the Roth. On the annuity side, it grows tax deferred. And when you take it out, that's when it becomes taxable.
Yep. Okay. That makes sense. Okay, Rod. So let's talk about examples and situations that illustrate why it makes sense to generally avoid tax deferral, realizing that there is a difference in the types of accounts we're talking about, right? The first section we talked about, those are the ones we usually avoid. The next section where it's 529 Roth, life insurance, annuities, we're certainly higher on those than we are on the front. And of course, Roth and life insurance, those are like, money in the bank. So we love that.
Yep, rock stars.
Okay, examples, Rod. Take us through some.
Okay, so the first one, why we want to avoid tax deferral on those pre-tax category is people assume that they're going to be paying less tax when they retire or be in a lower tax category. The challenge is that really true?
That's a fair question. It's a fair. Well, here's what I think. I think that there's a massive amount of debt, and the way that our country is going to eliminate that debt is going to be to increase their revenue. Okay, Rod, did you hear this? You probably did. Like an additional 300,000 IRS agents have been hired recently, and they're being put out into the field. Like, I just have a feeling that their goal at the end of the day is to collect more revenue, right? So with everything going on, it's just really hard to believe that there's any chance that long-term taxes are going to be lower in the future than they are today. And then you just take into account that if you look at historicals, we're actually in a very low tax environment. So if we took it back, like I almost wish we had the little graph that shows it, but it's kind of like, it's like pretty significantly lower than what we've seen in many of our past years. So paying the tax today generally makes sense, especially if we can put it in vehicles that give it to us tax-free in the future.
Absolutely. Yep. And I think that another thing that often happens is there's this misinformation about when you set the money aside in this pre-tax account, you're going to have more income later by doing that. And here, let me be more specific. So this happened to me. So I sit down with the HR department when I get a job, when I'm just out of college, and they say, hey, you should think about your future. You should participate in this 401k, and to think about the fact that you're going to have more money in the account because it's pre-tax, which that part of it is true enough. But what they are trying to say is you're going to have more money in retirement by having put it in the pre-tax account than you would if you did anything else, right? Pay the tax now, Roth, any other option. But here's the thing. If I'm in the same tax bracket when I put the money aside as I will be when I retire and I take that money out, then it wouldn't matter. Pre-tax, post-tax, 401k versus Roth 401k, the income that's going to land in my pocket is the same either way.
Well, so what that tells me, Rod, is that if that's the case, then early in your career, when you're not making any money, right? If you got your job and you were getting paid like $38,000 as a 24-year-old,
yeah, right.
Just a guess. Yeah, so but it doesn't make sense to tax defer when you're only making 40 grand a year.
It was the worst time. Yeah, absolutely.
Okay. So let's definitely put that in the examples of when not to tax defer.
Yeah.
And again, this is when people get into the habit of doing it. It's because it's just there. Now, we're going to talk about a slight exception to this here in just a second.
Okay, I'm excited. All right, but let's talk also again about a couple of other situations. And these next few are examples of people that we met with and who had been participating in this kind of tax deferred program and were not happy. So the first one that comes to mind is a couple that I met with, and they had set aside a lot of money into their retirement accounts.
Both like teachers, right?
Yeah, husband and wife, and they were just amazing savers. Like, it was just really impressive. So they got it in there, and then later learned about, hey, we want to go and start investing in real estate and things like that. Well, we have all this money built up in our retirement accounts. Let's set up a self-directed IRA, and then we can invest in these things that we want to do. They did, and they were really successful with it. They turned what was already a relatively large amount of money into a ton of money. Which they were happy about, right? There's no question about how happy they were about how successful they'd been. But what they were mad about is that they didn't want to take the money out because everything is going to be taxed as it comes back out.
I think that's huge, especially in the self-directed IRA world. Like, there is 100% a place for self-directed vehicles, but we also have to think about what that looks like long-term, right?
Mm-hmm.
It was one of those things that became like a really hot topic like 10 years ago, and all the real estate investors wanted to put as much money as they could into self-directed IRAs, and then realized like, oh, like there is some downside to this.
Yeah.
Right? There's some upside, but there's some downside. And so if the idea was, put everything into qualified plans and turn it into self-directed, like, you're going to end up in this situation, like you described, these people who, they don't like spending their money. They like that they've built a lot of it, but it's painful to take it out. So it's not like this horrible story. And yet it could have been much better just by making some simple tweaks and determining or deciding earlier that maybe some of that money that was going toward tax deferred stuff could go into the non-qualified space, where they can do a lot from a tax standpoint and hopefully offset some of those taxable gains, the taxable income that they're getting from the qualified plans. Right.
Because that's exactly what was happening. They were looking at their peers that were also successful in doing all that investing, but they were taking advantage of all these opportunities to save tax, the 1031 exchanges, et cetera, step up in basis that they just were not going to get because everything was inside of that self-directed.
Okay, Rob, why else should we avoid it?
Okay, so another example that comes to mind is a couple we were working with who, again, very prolific savers. He had been in the Air Force, so he had a pension coming out. They had a lot of money in their 401ks, et cetera. And what was really cool is when we started projecting their future income that they were going to be able to take out in retirement, and they were right on the doorstep. We were saying, hey, you're going to be able to actually have more income in retirement than you have now while you're working, which was amazing, right? They're thrilled about that. But then later in the conversation, as we got to the place where they realized, every dollar we spend for the rest of our lives is going to be income taxable. It was like their countenance changed. Like they were not very happy at that point in time. And so
it's an ugly pill to swallow. It's a hard pill to swallow, right?
Yep.
Okay, Rod, before we move into the exceptions and situations that we think it actually could make sense, and I did say that purposefully, could make sense or might make sense. I'm not going to say it always does make sense. Okay, but before we do that, Rod, talk a little bit about required minimum distributions, because we have to hit on this when we're thinking in this topic.
Yeah, this is another thing that makes people mad. So they have the money in their retirement accounts, and they're thinking, well, that's okay. I'll just take my income from other places, the real estate, the other things where I've been able to create cash flows.
They'll just give their kids the IRAs and 401ks and that kind of thing, right? And they can just live up. Well, it's not that easy.
No, because when you get it used to be 70 and a half, now it's 72. When you get to that age of 72, the government says you have to start taking money out of that account.
Gosh, and what's crazy, Rod, is that if you don't take the money out, they're going to dock you 50% of what you should have taken out.
Yeah.
So if your minimum distribution was 30 grand, suddenly that's 15 grand out the door just for not taking the money.
Mm-hmm.
Gosh, that's wild. Okay, that's an ugly one. We want to make sure we avoid missing RMDs. Is that fair to say?
Yeah.
And maybe even better, let's try to avoid, to the extent possible, having to take large RMDs in the first place.
Yeah.
If we can do that and get more money through tax-free savings vehicles, non-qualified accounts, real estate, these other vehicles that we can do more with, and that's a win. Okay, Rod, we've been teasing this, but I want to make sure we get to it. There are some possible situations that you could justify using a qualified plan or using tax deferral. Let's jump into some of what those are. So the first one that I think we need to talk about is when somebody's late to the game. And what I mean by that is when somebody hasn't been saving early on. I'll give an example. We have a really great client who came to us that are in the, he's in his 50s and he was making $600,000 a year from what my memory tells me. And he just didn't have a lot of money saved, right? And so he's sitting there and he's like, okay, I make a lot of money. I'd like to have a lot of money when I retire, but I don't have a lot of money saved up now. Okay, well, that situation, we kind of know that we're not going to be able to replace the income, which means that in the future, we can be pretty confident that the income level is going to go down. We don't know what the taxes are going to do, right? The taxes could very well move up or stay the same, but we do know that the income is going to go down. So in that situation, we socked away as much money as possible into a defined benefit plan so that he could save, hundreds of thousands of dollars for a handful of years, which he can then go and do something with. Well, that's a better situation. Obviously, the best situation would have been that we saved earlier, but in that situation when they haven't, it could make sense to use it, like something like a defined benefit plan.
Yeah. Yep. That's a great example. Okay. I have one.
Go for it.
There could be a situation where if someone has an abnormally high income year, and that could, well, just to give a quick example, let's say they have the regular, 500,000-600,000, like they have done in the past and are expecting in the future, but maybe they have an inheritance that comes in the form of a retirement account of their parents. They inherit it. All of a sudden they take on this additional hundreds of thousands, $500,000 of income in that year. And so they have obviously a much larger tax burden, unless if they can put some into a qualified plan, then they can defer some of that.
Yeah. And I think like another example would be like if you got a large bonus or had a really great sales year. If I'm a medical sales rep and I just killed it in the year, it could make sense to try to sock some of that money into one of these other places. Yeah. Now, and again, I say could because there's still a possibility that I do that and it's not the right choice. Because if taxes do skyrocket in the future, even in that situation, you probably would have been better off to pay it then instead of waiting and paying it in the future.
Right.
But it could be. It could be.
Yeah, because we do see situations where people will invest in real estate, gets bonus depreciation, et cetera, to offset some of that. But again, there could be, right? Could be an opportunity to do some.
Okay, Rod, another example that comes to my mind is I'm thinking of like a specialized surgeon or something like that. Somebody who has a really specialized skill. Maybe it's really taxing physically, mentally, emotionally, and there's a short window of time that's available, right? So if I'm that person, I'm making a couple $1 million a year. I'm really going after it. And I just know I can't keep at it forever, can't keep at it long term. Then in that situation, just like before, it could make sense to try to tax defer a few $100,000 each year so that you're getting ahead of the game, realizing that that income is definitively going to go down.
Yeah. Yeah. You're worried about burnout.
Yeah. Worried about burnout. Okay, Rod. So talk a little bit about the other one that we brought up is matching. Talk a little bit about the matching situation.
Yeah. In a 401k, Often, again, this is an employer offering you the opportunity just to participate in their 401k, and sometimes they'll offer a match. So if you put a portion, you participate, then they'll match up to a certain percentage. Often it's like, for every dollar you put in, we'll give 50% of that, or even dollar for dollar, we'll match that up to 3% of your income, or 6% or something like that. Those are common percentages. So in that situation, it's really tough to argue with free money.
Yeah.
Right. So, and it may not build much. This is certainly not going to be your primary vehicle for future retirement, but to the extent that you can capture the match, then we feel like it makes sense. Don't participate beyond that, but at least enough to capture the match.
Yeah, it's hard. Like you said, it's hard to argue with free money. If I'm getting 100% match on my first $5, like, I might as well take it. Okay, Rod, bring us home with the last exception to situations where we might actually use tax deferral.
Yeah, in this case, we're talking about creating guaranteed income in the future for that retirement cash flow planning. If I'm wanting to set aside a portion of cash that I have to create some future guaranteed, and interestingly, with a lot of the high income earners that we work with and high net worth people, even though they have significant amounts of cash flow they're able to generate through their businesses, the real estate, et cetera, there seems to still be this underlying concern about, well, what if in short periods of time, some of that goes down or goes away, and I want to make sure I still have something coming in. And so creating some level of guaranteed income is desired there. Well, doing it in a place like an annuity that creates some of that tax deferral can make some sense.
Okay, Rod. So we've talked about a lot of things here. We've talked about the various kind of ways that tax deferral exists.
Mm-hmm.
I have a tough question for you.
Okay, I'm ready.
What is the primary thing that our listeners need to take out of today's episode from your perspective?
Yeah, I would say that it's that you mentioned the loudest voice earlier, right? The loudest voice is telling everyone that they should participate in these, no matter who you are, no matter how much you make, no matter what your situation is. This is and should be the primary place where you're putting your money. And number one, to challenge that in a big way. And number two, to suggest it doesn't necessarily have to be that there's no place for qualified plan or for tax deferral, but at least learn about it, understand it, apply that to your situation, and then make your decision.
Well said. Okay, thanks everybody for listening to today's episode of the Money Insights podcast, and we'll see you next week.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.